Ladies and gentlemen, good day and welcome to the Cyient DLM conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Krishna Bodanapu, Non-Executive Chairman, Cyient DLM. Thank you, and over to you, sir.
Thank you very much. Good evening, ladies and gentlemen. I'm Krishna Bodanapu, Non-Executive Chairman of Cyient DLM, and welcome to Cyient DLM's earnings calls for Q4 of FY24. Present with me on this call are Anthony Montalbano, the CEO of Cyient DLM, and Srinivas Kulkarni, the CFO of Cyient DLM. Before we begin, I would like to mention that some of the statements made in today's discussions may be forward-looking in nature and may involve risks and uncertainties. A detailed statement in this regard is available in our investor update, which has been posted on our website. Our growth momentum continues, and we were able to post strong results in Q4. We broke our previous record of highest ever revenue in a quarter, which is a testament to the ability in strong execution and aligns with the broad growth that is being seen in the industry. When I look back at FY24, it is great to see several positive developments. After a successful IPO, we continue to see a lot of interest from investors in Cyient DLM. We have received several customer appreciations, awards, and recognitions during this year. Our order execution capability has instilled higher confidence in our clients, which is now reflected in our pipeline. Our customer engagements have been far more collaborative, and conversations are forward-looking with all our top clients. We have had some uncertainty due to the Israel-Hamas war, but our supply chain and execution performance kept our confidence high throughout the year. Our Israel business, or our business that's dependent on Israel customers or supply chain, continues to do very, very well, and we're grateful for them for their resiliency in the uncertain times that they face, and we're quite confident that this will continue into the next years going forward. The outlook for FY25 looks promising, and we're really excited about the prospects that we see ahead. Finally, and most importantly, I want to thank my team, customers, suppliers, and the entire investment community for being a part of Cyient DLM's successful journey in FY24. As we step into FY25, our first full year as a publicly traded company, we will stay ahead of the curve and support our clients in managing the growth that they are seeing. I now hand over the call to Anthony and Srini and request them to walk us through the business updates and financial performance. Anthony, over to you.
Great. Thank you, Krishna. So I thought I'd start, and as we finish off our first fiscal year here, I thought it'd be important to give a view on how the industry continues to traject for us. And so we continue to get very strong what I call tailwinds from what's been happening in the industry from a global supply chain and solution perspective. This has been referred to as the China Plus One strategy. This is where regions, including India as well as others, are seeing new opportunities. And this is very strong. This has been a very strong driver of business for us, including the specific aspects of what we're seeing in India on the EMS market there in that regard. Even the EMS industry overall is simply massive, right? So you're looking at at $1 trillion industry that has a CAGR of 5.4% at that level, with the Indian market growing at much higher rates, which we'll cover here in a minute. And so, this really is an outcome of not just what's happening from a geopolitical and aspects, but also just there's significant technology changes happening across various sectors. This includes EVs, communications, AI, Industry 4.0. So all these factors continue to combine to give us a very robust opportunity to grow in this market. Let's go ahead and go to the next slide. So the part of the market that Cyient DLM is focused on is a specific aspect of it in two parts. So first of all, we focus on what we call high mix, low volume. Okay, so this part of the market often involves what we call mission and safety critical electronics manufacturing services. These are electronics that go into aircraft, medical devices, very high reliability type industrial applications. And so this segment, and especially in India, this segment is having very high growth rates. We're seeing 30% growth rates over over just a few years alone. So this is driving a considerable amount of new opportunities that were really not even slated for these sectors in the past. And the focus areas for us really aero and defense, medical and industrial. This is our core. These are the areas that we are seeing the most growth with our core clients. And at our size business, and when you look at the size of the market overall, there is just a tremendous amount of runway in front of us, just focusing on these core sectors. And so this is really part of our DNA, and this is where we'll continue to add value for our clients, really for the foreseeable future. Let's go ahead and go to the next slide. So, getting now down to specifically to, Cyient DLM, as we look at some key highlights of the year, we've had a very strong year in terms of growth. We've had to make some investments and really expand in order to support this. So, we did inaugurate a new facility in Bangalore focused on precision machining, and this was a facility that we greenfielded, and we have some of our large key clients in there. This is really a unique offering for the EMS space. This is really more along like a vertical integration aspect of it, where we're bringing value to our clients beyond just standard EMS type services. And then we also just recently, a couple weeks back, inaugurated a new manufacturing facility in Mysore. And so this is really just adjacent to our core operation. This is really a great opportunity to expand in a key region for us, where we have a lot of our key clients. This also gives us more space and capability and capacity to not only support the current business growth, but also business that we have forecasted in other parts, not just EMS, but also areas such as cable and wire harness and other types of offerings that we can bring to our clients. So those are some key expansions that we completed this past year, and some investments also that we've made on the capabilities perspective. So build to spec, the ability to do design and manufacturing is really a core differentiator for us. On our last quarter call, we highlighted that we brought in a CTO for our business to help drive this specifically. And this is directly aligned to some very strategic programs that we will be announcing where we are bringing these types of solutions to our clients. And this is really a unique differentiator for us as it continues, continues the relationship that we have with Cyient Engineering and allows us to bring those integrated solutions to our clients. And so this is really a unique capability that we can bring forward and that we are really gaining momentum in. We've also invested in the supply chain. This has been probably a number one pain point that we've heard across the industry. It's usually amongst the top discussion points with many of our clients. The good news is that it's really improved, right? When we look at the outlook, there's still a tremendous amount of focus on supply chain, but it's very different than when it was, about a year and a half back, where there was still uncertainty, and now this appears to be much more stabilized, and that trend and outlook seems to have a pretty broad sentiment. And so for us, though, we have continued to invest in this area so we can actually provide solutions to our clients from a supply chain perspective. That means designing in alternate components. That means being able to work with a supply base proactively and really bring just a higher value offering in there. And so we brought in leadership and also mid-level talent in that organization to really help us lead the industry in that regard. We've also invested in go-to-market and key sales talent, really making some key hires to help with the engagement that's required for the type of clients we work with. We have a relatively small number of clients for the size of business we run. Our strategy is focused on working with industry-leading OEMs and drive our growth along with them. And this past year has worked out well in that regard. A lot of our growth has come from working with these top clients, and we'll also discuss some of the new logos that we've added as well. And so, these key investments really have led to some recognition in the industry. We received awards from the electronics sector. We received supplier excellence awards, and then also just some national export awards as well. Just recognition of the growing impact we're having regionally here as we continue to grow our business in India and globally. Next slide. So to expand a bit on, as we look forward, what our strategy is, right? We've completed a successful FY24. And as we look at FY25 and beyond, some key things that really stand out for us is that we are focused on large deals. Again, we work with large OEMs for the most part in high-value segments, which we've discussed. And so the transactions that we do with them are in relatively large scale, especially for a company of our size. And this really gets into more of the, not just the size of the opportunities, but also the depth. We talked a little bit about the built-in specification aspects, enabling design services along with manufacturing. And this allows us to go in and even as we work with our sales team and look at our key accounts and put a robust account planning aspect in play for this, we're really just scratching the surface on many of these key accounts. So we just see these fundamentals as being very strong pillars as we drive the growth of our business. One other part is we also have an inorganic strategy that we are executing well on, and we see this as having what I call material impact going forward as we continue to add capability, capacity, and also potential geo offerings. We will be making some additional updates in that regard as soon as we're able, but that is progressing nicely, and excited to bring more updates in that regard soon. And we'll also continue, I've highlighted the importance of the core industries that we are focused on, aero, defense, medical, and industrial. But that being said, we have had opportunities in other sectors, and we will continue to evaluate those. There could be an opportunity there to look at areas like EVs or automotive or communications, where there's a right value profile. We will definitely take a look at those opportunities, and we have, and we have been doing so. So, let's go ahead and go to our next slide. So that kind of covers, really from the business overview and the strategy overview of kind of, where we've been and the direction we're going. And I'll turn it over to Srinivas, our CFO, to give more details on some of the finance updates.
Thank you, Anthony. Good evening, ladies and gentlemen. Thank you for joining the call today, and thank you for your interest in Cyient DLM. This being the first year of operations for us as a listed company, we are happy to present the full year financials for FY24 along with our quarter 4 performance. So first I'll walk you through Q4, and then we'll spend a few minutes on the full year results. We closed Q4 with a revenue of 3,618 million rupees or 361.8 crores, which represents a year-on-year growth of 30.5%. Our operating profit for the quarter is 38 crores, which is a year-on-year growth of 19.2%. We had mentioned that we will reach double-digit margin in Q4, and we are pleased to report a 10.5% EBITDA margin for the quarter. Our profit after tax is 227 million rupees or 22.7 crores, which is a year-on-year growth of 80.7%, and the PAT percentage is 6.3%, which is 175 basis higher than the same quarter previous year. We closed the year with an order backlog of 21,705 million rupees. This has declined by 262 crores when compared to the same quarter previous year. We will get into the details of the order book and the sales pipeline in the subsequent slides. The next slide, the trend on the revenue, operating profit and net profit over the past 5 quarters. And as you can see in all the metrics, we have a nice trajectory of growth and improvement, which we hope to sustain in the coming years. We'll take a quick look at some of the other KPIs which are important and give an indication of the overall health of the business. If you see our net working capital, it is at 79 days, which is the lowest it has been in the past 4 quarters. This metric is best looked at as an average for the year and not at any point in time. However, just to give some color on how the working capital was managed in Q4, we were able to drive collections and reduce the overall overdue receivables to end the DSO at 57 days. We were also able to reduce our inventory holding by 20 days in Q4. There were no new significant customer advances, and this number will go down as we square off the previous advances with revenue as we book those revenues. The net result of all of these actions meant that we generated a positive free cash flow of nearly 129 crores, which is a significant achievement for us. This number would have been higher but for the holidays in the last week of March, and some of the collections spilled over into April as well. In terms of the mix of the business, there is not much change from what we have presented earlier. Our growth, as you can see, is driven by aerospace and defense. We have taken several steps to focus on industrial and medtech and should see higher share of business from these verticals as we go forward. PCBA and exports continue to be about 2/3 of our businesses, and that share has remained almost consistent for the last few quarters. We We now will reflect on the full year performance. Our revenue for the year is a little shy of 1,200 crores at 1,191.9 crores, which is a growth of 43.2% year-on-year. Our operating profit grew by 26.5% year-on-year, and our net profit by 92.9% year-on-year. The fixed asset turnover ratio reveals how efficient we are at generating sales from our existing fixed assets, and we are happy to report that we have improved from about 6.8x last year to about 8.6x in the current year. Our debt equity ratio is healthy, and we still have the IPO proceeds to help us fund the growth requirements in the next 2 years. While we close the year with a net working capital of 79 days, as I said earlier, we should look at the average net working capital. It was more than 100 days for us in the year. This is higher than where we want to be, and our near-term goal is to bring this to about 90 days and then improve from there on. Our FCF for the full year is negative 104 crores, and even though this is negative, it is manageable and in control given the 40+% growth that we saw in the business. This slide provides a tabular view of the P&L for Q4 and for full year. It has comparatives to the previous quarter, previous year, right, which you can refer to. We have discussed most of these points in the previous slides, and hence I'll not spend too much time on this. Just a couple of call-outs. As you can see, the year-on-year increase in employee costs has resulted in lower EBITDA growth compared to the revenue growth. These were planned investments in headcount to strengthen the team for the growth we see in the business. As we add scale, this number will not increase linearly, and we'll start seeing the benefits of absorptions kicking in. Our PAT growth is significantly higher than the operating growth because of the increase in other income. Other income, as you all know, is higher because of the IPO proceeds. As we use the funds to grow the business, you will start seeing the benefit getting converted into higher operating profits. A quick look at the mix of industry and product category and how it changed from FY23 to FY24. Our industry mix has changed in FY24 with a higher share of revenue coming from aerospace and defense industries. While we take advantage of the higher traction we are seeing in these two industries, we remain committed to building a more diversified portfolio, as alluded by Anthony in his earlier slides. We also see the share of our business from PCBA has increased in FY24. We have, as mentioned in the past, do not have any preference on the split between box build, PCBA or other parts of our businesses, as these are driven by specific programs and customer preferences. Our objective will be to maintain and enhance the margins despite the product mix that we are into. Lastly, on the IPO proceeds utilization, we have cleared the external debt and have used approximately 80 crores for funding the working capital requirement that was used towards growth and a small amount towards capex. There are no deviations in the usage of funds from the objects stated in the RHP. So with that, we conclude the presentation and open up the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take a first question from the line of Vipro Srivastava from InCred Research. Please go ahead.
Hi, am I audible?
Yes, please go
Hello?
ahead. Yes, please go ahead.
Sure. So first question was regarding the geopolitical thing in Europe. So, Cyient has clients like Thales and Rafael. A company like Thales is seeing huge order inflows because of the whole geopolitical thing. So, is it a possible opportunity for DLM? Where do we see ourselves in that sort of space?
Yeah, I can answer that question. I caught the question. So I think there is, in general, there is a fairly significant increase in defense requirements and in defense spend by governments and therefore from our clients. So we are seeing a sort of outcome or direct benefit of some of that also coming through. There's also another element because there's a number of offset type requirements that are also coming from the Middle East region in general, and we're also looking at how we can address those more effectively. But to your point, absolutely, there is just more demand with what's going on in that region, and that is translating to orders for us, both in terms of extension of existing orders, but we're also starting to see some of our pipeline is building in with some of these new orders, new equipment, new type of requirements.
Right. Second question was regarding the other current liabilities, which is affecting the cash flow statement. So that has gone up sharply. So how do you see this shaping up for FY25? I guess it's because of advances from customers. So I guess it has declined. So how do you see it shaping up for FY25?
I think we will continue to see the headwind of lower customer advances even as we get into FY25, right? I think that's just the nature of the business. As we move more into non-India businesses and the growth driven by those industries, there will be that. But I think the way to manage that is to sort of control the inventory, right? I think number of days we've had some success in Q4 reducing the inventory days, and we hope to sort of sustain from that going forward. So year on year, we do expect improvement in the net working capital. The composition might change a little bit in terms of what is playing out there, but it will be, we hope to be at an average of between 90 to 100 days in FY25.
Right. And last question regarding the Honeywell Anthem deal, which is going into advanced air mobility. So where do you stand currently on that? I mean, a lot of these advanced air mobility companies are vying for certification. So where does Cyient DLM stand? When do you see any order materializing from that, if any? I mean, any timeline if you have for that?
Yeah, so as far as specific client programs, we are limited on the amount of detail we can disclose, but as far as what has been communicated in the past on that, that sector and these specific engagements, I would say are very much on track, are really quite strategic for us. So that's a core part of what we expect to see in the coming fiscal year and the years after that as far as what's been communicated in the past on it.
Okay, cool. Thank you. Thanks a lot.
Absolutely.
Thank you. The next question is from the line of Venkatesh Balasubramanian from Axis Capital. Please go ahead.
Yeah, thank you for the opportunity. The first question is, when you ended FY23, you had a backlog of almost 24 billion, which was basically order backlog by sales of almost 2.9 times. Now, when you're ending FY24, you're at a backlog of 21.7 billion, which is an order backlog of sales of around 1.8 times. While I understand you have these long-term framework agreements with clients, especially somebody like Honeywell, does the fact that your backlog, your first of all order wins in the current year has been much weaker? It's been half the order win that you won last year. So that is why your backlog is weaker. Is that something that we need to be worried about when we are thinking about revenues for FY25, or it actually doesn't matter because as we progress into maybe the first or the second quarters, some of these orders will fructify and you will not have any problems of growth? That is the first question.
Yeah, I can go ahead and take that. So it is, there definitely has been some consumption in the current fiscal year of the order backlog. And, as I've indicated earlier in my comments that, we do have some key programs that we will be announcing, which will have quite an impact on building that backlog back in place. So, one nice aspect about our business and the sectors that we play in is we actually have a pretty long window of, order commitments and outlook, right? It's much different than a consumer business, for example, where you might only get a 3-month view. In our business, we tend to get a, 9-month view or even longer. So